Welcome to Breaking News to Trading Moves. Think about, the last time you watched a trade flash green, you panicked, and you just sold half your position,
Oh, yeah. We've all been there.
right? And you probably patted yourself on the back for being really responsible and locking in those games.
Definitely. It feels like the smart thing to do.
Exactly. But what if that exact habit, the one that helps you sleep at night, is actually the mathematical reason your portfolio is just, well, bleeding out?
It is a really brutal realization for a lot of people. I mean, we're constantly taught that nobody ever went broke taking a profit.
Which sounds great on paper.
Yeah, it does, yeah. But that old saying completely ignores the actual mechanics of how profitable trading works.
Right.
You might be saving yourself from a fleeting moment of discomfort, but, you're simultaneously destroying the architecture of your winning system.
So that's our goal today. We're looking closely at this widely accepted practice of taking partial profits.
Right, scaling out, trimming the position, whatever you want to call it.
Yeah, exactly. We want to examine the hidden mathematics and the psychological traps behind hitting that sell button early.
Because the goal is to determine when taking a little off the table is a tested mathematical strategy versus when it's just, well, an emotional reflex masking your fear of losing.
Right, because entering a trade is actually the easy part.
Oh, absolutely. Managing it while your money is actually on the line, that's where the math either works for you or against you.
So let's start with the psychology behind the trade before we even look at the numbers.
Mm,
Because human emotion is what triggers that early exit in the first place. Right.
100%.
Like you sit there watching the screen and the anxiety just builds. It actually reminds me a lot of the cash out button on those modern sports betting apps.
Oh, that is a perfect parallel. Yes.
Right. So let's say you place a $50 bet on a parlay, 3 legs hit, and suddenly the app flashes an offer.
Yep, the little flashing green button.
Exactly. They'll give you $200 to walk away right now, even though the final payout was supposed to be $1,000.
And your brain just starts screaming at you to take the guaranteed money.
Yeah. Because you're terrified the final game is going to ruin everything. You don't want to lose that initial $50 or the 200 you're supposedly up.
Right, but here's the thing. The app isn't offering you that cash out of generosity.
No, of course not.
They're offering it because mathematically, over thousands of instances, the odds are heavily in their favor if you take the early exit.
Because they know human anxiety will make you forfeit the true mathematical value of the bet.
Exactly. And in trading, I mean, you are basically offering that bad deal to yourself.
Wow. Yeah, that's so true.
You've already taken on the initial risk, right? You're exposed to the probability of a specific outcome.
Right, you paid the price of admission.
Yes. But the moment the probability starts looking favorable, the anxiety of potentially losing a small initial gain just totally overrides the logical reason you entered the market in the first place.
Because taking something off the table creates emotional relief.
Oh.
It just instantly reduces the fear of a reversal.
It does. It's that physical sigh of relief.
Right, you see green on the screen, you sell half your position, and your shoulders literally drop.
Yeah.
You think, okay, well, whatever happens now, I'm safe. It's a risk-free trade.
Yes. But what is absolutely fascinating here is the unseen cost of that relief.
Okay, tell me about that. What's the cost?
Well, when profit appears, traders often just stop managing the position according to actual market structure.
Meaning they stop looking at the actual chart.
Exactly. They stop looking at support, resistance, or the broader trend. Instead, they start managing the position based purely on their own discomfort.
Oh, wow. So you're no longer trading the asset in front of you, you're just trading your own nervous system.
That is exactly it, which completely detaches you from your original trading plan.
Because you enter with this logical, well-reasoned target, but the moment real money is fluctuating on the screen, all that logic just evaporates.
It completely vanishes, and that leads to a really dangerous cascade effect.
A cascade effect. How so?
Well, once you let fear dictate that very first exit, it infects the rest of the trade.
Right.
First, the fear takes over, so half the trade is closed out early just to secure a win.
Okay, so you lock in a little bit of money.
Right. Then, because the trader is now operating entirely in a defensive mindset, the stop loss is moved way too quickly to the break-even point.
Oh, I do that all the time.
Most people do. But they choke the trade. They leave it no room to breathe during just normal market pullbacks.
Right, the market naturally wiggles and you get stopped out.
Exactly. And finally, the remaining position is now so small that even if it survives and actually hits the original target, the monetary gain is just too small to matter.
Man, I have absolutely done this. Like you buy a volatile tech stock, it pops up 3%, so you panic, sell half, and move your stop up.
Yep. And then what happened?
Then it drops 2%, stops you out on the rest, and then rips 20% higher over the next 3 days.
And you're left holding pennies.
Exactly. You're left holding pennies while the stock does exactly what you thought it was going to do.
Right. You stunt the growth of your winning position.
Yeah.
The ultimate result of this cascade effect is generating smaller winners while still sustaining the exact same full-size losses on the trades that don't work out.
Wait, say that again. That's a crucial point.
Sure. When you're wrong, you lose your full risk amount because your stop loss hits before you can feel any relief.
Right, because you didn't have a chance to scale out of a loser.
Exactly. But when you're right, you artificially cap your upside.
So you're feeling your losers and starving your winners, all in the name of feeling responsible.
Precisely. And this behavior is particularly destructive because of the mathematical realities of trading systems.
Okay, so we need to move past the feelings and look at the actual math.
We have to. This is where the illusion of safety really just falls apart.
Let's get into those cold, hard numbers then. Because when we look at the data, there's a very clear mathematical example of how this plays out.
Yes, let's walk through it.
So let's imagine you're risking what we call 1R on each trade.
Right, that just stands for 1 unit of risk.
Exactly. Let's make it really concrete. Let's say your standard risk is $1,000 per trade.
Okay.
If the trade hits your stop loss, you lose $1,000.
Right. 1R is your baseline unit of capital exposure. It normalizes everything, so it's easy to track.
Perfect. So you take a series of trades. Several of them lose that $1,000.
Which is completely normal.
Right. Some of them make $1,000. But a few of them, the really prime setups, are designed to produce $4,000 or $5,000.
Yes.
4 or 5R.
Yes. Those are your target winners.
Now hold on. If I'm staring at a chart and my account is up $1,000, my brain is telling me that selling half guarantees a win.
Of course it is.
So doesn't closing half my position at 1R improve my win rate?
Yeah.
And isn't a higher win rate mathematically better for my portfolio?
I love this question because this is exactly where intuition betrays the data.
Really? How?
Well, yes, closing half your position at 1R will almost certainly improve your win rate. You're booking profits more frequently.
Right. And it feels fantastic.
It feels amazing, but, and this is the critical distinction, a higher win rate does not automatically equal a more profitable strategy.
That sounds completely counterintuitive. I mean, winning more often should mean making more money. How can that not be true?
It feels like it should be true, but what actually matters for long-term survival is something called expectancy.
Expectancy. Okay, break that down for me.
Your overall expectancy is the relationship between 4 distinct variables: your win rate, your average winner, your average loser, and your trading costs.
Okay, so win rate is only one piece of the puzzle.
Exactly. Let's walk through your exact $1,000 risk example.
Let's do it.
Imagine you buy a position and it moves in your favor by $1,000, which is 1R.
Okay.
Your anxiety kicks in, you want that green on the screen, so you sell half of your position to lock in a $500 gain.
Okay, I'm feeling good at this point. I've secured some profit. Even if it reverses, I made something.
You did. But let's say the trade continues doing exactly what you originally thought it would do.
Right. It keeps going up.
Yep. And it eventually reaches your original 5R target, which would be a $5,000 move on the full position.
Okay.
The remaining half of your position reaches that finish line. What is your actual total return?
Let's see. I made $500 on the first half, and I made $2,500 on the second half.
Right.
So my combined result is $3,000, or 3R.
Exactly. So instead of making 5 units of reward, you made 3.
Wow. I left $2,000 on the table.
Correct. You sacrificed 2 full units of reward just for the emotional comfort of locking in that early profit.
That's a massive difference.
It really is. Now, 3R is still a profitable trade. $3,000 is great.
Right. I'm not complaining about $3,000.
But remember the other side of the expectancy equation. When you lose, and you will lose frequently, you are losing the full $1,000.
Right. Because I didn't scale out of the loser.
Exactly. Over dozens or hundreds of trades, sacrificing 2 full units of reward on your biggest winners creates a considerable drag on your returns.
Because I still have to pay for all those full-size losses.
Exactly. And we haven't even factored in the friction of the market yet.
Friction. Like trading costs.
Yes. Every time you trade, you deal with slippage and commissions.
Right. The broker always gets their cut.
Slippage is simply the difference between the price you see on the screen and the price you actually get filled at when you hit the market order button.
And if you're constantly taking tiny early profits,
Slippage eats up a massive percentage of those small gains.
wow,
Once you factor in those hidden costs and the inevitable losing streaks, that missing $2,000 on your big winners can be the absolute difference between a system that grows your capital and a system that slowly bleeds your account dry over a year.
that is wild because those 5R winners aren't just like bonus money for a vacation.
Not at all.
They are the structural foundation of the entire account. They are mathematically required to pay for all the 1R losses you took along the way while trying to find a good setup.
You've hit the nail on the head. This is especially dangerous for specific types of strategies like trend following, breakout, and momentum systems.
Right, because those systems inherently rely on catching one major outsized move to cover several small, inevitable losses.
Exactly. A trend follower expects to be wrong frequently.
They might test the market, get stopped out, test again, get stopped out again,
Right. They might have a win rate of only 35 or 40%.
which sounds terrible to a normal person.
It does. They endure a high frequency of small paper cuts. The only reason a trend following system works is because when they finally catch the trend, they ride it for a massive gain.
They capture the tail end of the distribution.
Exactly. If a trend follower reduces their position size during the early stages of a winner just to secure a small gain, they're completely dismantling the mathematical expectancy of their own system.
Because they're keeping the high frequency of losses, but discarding the magnitude of the wins.
Yes, they're cutting off the right tail of the returns.
That is a really stark realization. You think you're actively managing risk, but you're actually sabotaging the very payoff that makes the strategy viable in the first place.
It's a tough pill to swallow for a lot of traders.
But this brings us to a really crucial pivot point. When we look at the data on this, it forces a more nuanced conversation.
Right, because the math doesn't say partial profits are always wrong in every single scenario.
Exactly. The problem begins when traders use them automatically, without checking if the numbers actually support the decision.
That's a vital distinction. There is a place for scaling out, but it has to be deliberate, planned, and supported by your own historical metrics.
But hold on, if I'm staring at a chart and my account is up $500, my brain is just screaming at me to lock it in.
Of course.
How do I know if I'm being a smart risk manager or just, well, a coward? What questions should we be asking ourselves before we hit that sell button to take off a partial position?
There's a rigorous set of diagnostic questions you have to run through, and ideally, you do this long before you're in an active trade.
Okay, give them to me. What's the first one?
The very first question is the most objective. Does your historical testing actually show that scaling out improves your expectancy?
Meaning, have you actually run the historical data on your specific strategy to see if taking half off at 1R makes you more money over 100 trades than holding the full position to your target?
Precisely. If you haven't run the numbers, your decision is based entirely on feelings, not data. You're just guessing.
Yeah, okay, that makes sense. What's the next question?
The second question you need to ask is the exit based on a structural price level or just the presence of unrealized profit?
Oh, that's a sharp question.
Right. Are you selling because the asset hit a major historical resistance line where sellers always step in?
Or are you selling simply because your account balance is flashing green and you're scared it'll turn red?
Exactly. One is an objective technical observation of the market. The other is a biological reaction to your own account balance.
And the market doesn't care about your account balance.
The market doesn't care about your entry price. It doesn't know where you bought in, and it certainly doesn't care that you are currently up $500.
Right. The market just moves from liquidity to liquidity.
Exactly. The market doesn't know you exist.
Here's where it gets really compelling for me. The next question is about what happens after you sell.
Right. How often does the price actually continue to the original target after a partial exit?
This is where you have to be honest with yourself, right?
Yes. This requires rigorous journaling. If you review your past 50 trades and find that 80% of the time the asset marched straight to your final target after you scaled out, the market is telling you very clearly that your early exits are costing you serious money.
You are interrupting a winning process for no statistical reason.
None at all.
And what about the size of the position that's left over? We talked about that cascade effect earlier. You scale out and you're left with like 10 shares.
Right. You have to ask, is the remaining position large enough to benefit from an exceptional move?
Because if it's not, what's the point?
Exactly. If you scale out so heavily that the remaining position is microscopic relative to your overall portfolio size, why are you even keeping it open?
It becomes a phantom position that provides no real capital growth.
It's just there so you can tell yourself you caught the whole move.
I call that the ego position.
The ego position, yes.
You keep a handful of shares just so you can take a screenshot and
No.
post it online, claiming you rode the trend all the way to the top, even though it made you almost zero actual dollars.
That's a great term for it. It satisfies the ego without benefiting the portfolio at all.
Totally.
And that leads to a broader mechanical debate. Does reducing size actually improve your execution, or does it just hide a fear of holding winners?
Because sometimes traders say, well, if I take half off, I can let the rest ride.
Right. But they need to ask themselves if a structured trailing stop would mathematically produce a far better outcome than scaling out.
Okay, let's explore that debate. Mechanically, how does a trailing stop solve this better than selling half? Because to a lot of people, taking profits along the way sounds exactly the same as trailing a stop loss.
It sounds similar, but they are mechanically opposites in terms of upside potential.
Okay, walk me through it.
Let's say you buy a stock at $100 and your stop loss is at $90.
Okay.
The stock moves up to $120. If you scale out and sell half your shares, you have immediately removed 50% of your volume.
Right, you've permanently capped your upside.
Exactly. But suppose instead of selling, you use a trailing stop, moving your stop loss up to $110.
So if it drops back to 110, you're out, but you still made $10 a share.
Right. You've protected capital, you've dynamically reduced your downside risk to zero, and locked in profit.
But here's the crucial difference.
What's that?
You still have 100% of your shares exposed to the upside.
Yes. If that stock rips to $150, you capture that massive move with your entire original position.
Wow.
A trailing stop preserves the asymmetrical upside that makes trading profitable, while scaling out chops that asymmetry in half immediately.
That makes complete sense. You're keeping your full volume on the field to catch the fat pitch, but you're raising the floor underneath you.
Exactly. It's about replacing assumptions with mechanical logic.
Okay, but let's talk about the valid use cases, because we want to be balanced here.
Right. We aren't saying you should hold every trade with a death grip.
When does scaling out actually make sense? When does the math say, yes, taking partial profits here is the correct maneuver?
Well, dealing with extreme volatility is one major scenario.
Like trading highly erratic crypto assets or small cap stocks that can swing wildly on a single news headline.
Absolutely. The data supports managing volatile positions proactively. If an asset suddenly becomes highly erratic, reducing your exposure can be a mathematically sound way to protect capital.
Because you want to avoid unpredictable gap downs that might blow right past the stop loss.
Exactly.
Or approaching known resistance levels, like we mentioned earlier, if there's a clear ceiling on the chart.
Yes. If your data shows that an asset frequently stalls or reverses at a specific moving average or a historical price zone, taking partial profits right at that level is a strategic maneuver.
It's planned.
Right. It's based on market structure, not your internal anxiety meter.
It's proactive, not reactive. You decided to do it before the trade even opened.
Exactly. And another valid scenario is when reducing exposure allows the trader to properly follow the remaining setup.
So like a psychological compromise.
Basically, yes. If taking 25% off the table is the only way a trader can physically withstand normal market pullbacks without panicking and closing the entire position prematurely.
Then that partial exit actually serves a structural purpose.
Right. It is facilitating the execution of the broader strategy.
But the key differentiator here, and this is what everything hinges on, is that a planned exit at a defined structural level is entirely different from selling, just because holding a green position feels emotionally uncomfortable.
That is the core takeaway. Traders can and should compare different approaches.
Right. You can backtest taking 25% off at 1R.
You can test closing half at 2R. You can test holding the full position to the ultimate target, or using the mechanical trailing stop we discussed.
The specific method you choose is less important than why you chose it.
Exactly. The answer must come from the data.
It cannot come from whichever method feels the safest during the heat of one specific trade on a random Tuesday morning.
Precisely. If you're making the decision while the trade is active, based on your current heart rate or how much sleep you got the night before, you are no longer operating a system.
You're just reacting to stimuli.
You are.
Okay, let's synthesize this core lesson for you, the listener. The objective of trading is not to hold every single trade forever.
Right. We aren't advocating for blind holding.
And we aren't saying you should never take a profit. The actual goal is to ensure that your exit process actively supports your overall statistical strategy rather than quietly draining its potential.
Every single time you cut a winner short just to feel safe, you are putting a massive burden on your future self to find even more winning setups just to break even.
It's about aligning your actions with your mathematics, not your emotions. You just have to let the math do the heavy lifting.
You really do.
Well, as we wrap up today's analysis, there's one final thought we want to leave you with. It's a concept that perfectly encapsulates the tension we've been exploring between logic and emotion in the markets.
Right. If your trading entry relies on the objective math of the market, but your exit relies solely on the biology of your own anxiety, who is really managing your portfolio?
Thank you for joining us on Breaking News to Trading Moves. Remember to trust your data over your discomfort. We'll catch you next time.